Hello and welcome to the quarterly review. Let's take a look at how we did in the last quarter of 2016. Let's first of all start off with the actual performance numbers. And in the fourth quarter, we had a rate of return a little over 7%. That compares with the TSE rate of return of 4.5%. And the growth rate of return, which was 2.1%. Now, the growth rate, that's the target we have, is for 70% the stock market and 30% the bond market. So we take the TSE index and we take there is a bond market index as well, combine them on a 70-30 basis, and that's where you get the 2.1%. Actually, in the fourth quarter, the bond market had a very negative rate of return, so it really dragged down the rate of return of the growth blend. So we had a great quarter, and the year overall, 23.6%, was just incredible. And of course, that's the reason why we had our party at the top of the Calgary Tower. We do that when we do something really outstanding, and it was just an incredible year. And the TSE had a total rate of return, including dividends, of 21%, and the growth blend had 15%. So all in all, it was a super year, and let's hope we have many more like that. But let's go over and see how we did that. First of all, on a charting basis, this is how we've gone over the last couple of years. This was from the peak of the Toronto stock market back in August of 2014. For the next year, 2 years plus, the TSE was only up 5%, including dividends, and we were up 35%. And last year when we had our party, it was because in January of 2016, we were up when the stock market had a big fall. So we were up 8% when the stock market fell 20. Then we turned around and went up more than the market when it went up. So combined, we were up 35% when the Toronto Stock Exchange was up 5%. So once again, pretty incredible situation. So let's take a look at the big picture, because I talk about this every quarter, and every quarter has been the same for the last X number of years. So I'm sure you've been very bored at seeing this particular thing, but all of a sudden now we're seeing some big changes. So this is going to get more interesting as we go along over the next year or so. But this is the big picture. And people that have been dealing with me a long time realize that at certain times when the stock market is more dangerous than normal, we own less of it, as we did back in 2008. And so we have a sliding scale of how much we have in the stock market. That 70-30 stock bond ratio, that's for people that leave it there. That is not the best way of managing your money. Much better to have more money in when things are safe and have less money in when it's more dangerous, so that overall you might be 70-30 over a 5-year period, but you have more money in when it's going up and less money in when it's going down. So that's what I try to do. And so I'm following 3 key indicators: valuation, sentiment, and the economic outlook. So with valuation, it's safer to own stocks when the stock market is cheap. And it's more dangerous when the stock market's expensive. So up until the Trump election, things were cheap. If you remember, I was saying that the dividend yield on the stock market was much higher than the bond market yield in both Canada and the US. But what's happened since the Trump election is that interest rates have shot up very dramatically. In the US, they've gone from 1.4% up to 2.6%. So, going up 1.2% was a huge gain, almost doubled the rate of interest. And so because the stock market's up, the dividend yield has gone down from 2.2% down to 2%. So instead of being cheap, we're now into this sort of area over here where it's sort of a question mark. It's not expensive yet, but I will say that if interest rates were to go up quite a bit more, or if the stock market was to go up quite a bit more, we would be into this area over here, and that is an X. That would mean on valuation, the stock market would be expensive. Now in sentiment, for the last X number, 2 or 3 years, we've been in this sort of pessimistic range. Occasionally when the market started to go down, people got panicky because they were thinking, well, we've been 6 or 7 years into this bull market, and it looks like it's going to eventually tumble into another crash like 2008. So people have had this mindset of it being very sort of dangerous. That was good because panicked or pessimistic is always a check mark. But what's happened in the since the Trump election, we've migrated all the way over to optimism, and if it gets up further, I think we're going to see a really bubbly sort of like can't miss kind of feeling. And so that's this one is definitely an X already. I'm willing to give it more room because it's only new, this incredible surge of optimism. Not just the stock market optimism, we're talking consumer sentiment, we're talking about business optimism. So we have this incredible surge of optimism. And on the economic outlook, for the last 7 or 8 years, it's been positive. The leading economic indicators have been positive solidly. And now it's even more so because people are expecting a tax cut in the U.S. They're talking about deregulation. They're talking about infrastructure spending. So we've gone from a check mark to 2 or 3 check marks. So the situation here is now we're in a question mark for value. We've got an X for getting over to sentiment being too high. And we got 2 or 3 check marks down here. So I would say that somewhere sooner rather than later, I can envision scaling back on the stock market as it gets going higher and higher. So that is a new thing and something that I was really wanting to share with people. Now last year when we were super positive for the last few years, my compatriots, just thought I was crazy, and yet we were right to be in the market 100%. And because that kind of panicky feeling and what I considered fair value, cheap value in the stock market really turned out to be the case. Now everybody's getting super optimistic, and unfortunately that means we're going in the opposite direction. Now this is a blank screen. This is the real thing. This is what I'm trying to show here. But what I want to show is, we get into the trees in the stock market, and we stop looking at the forest, right? And so what I want to do is emphasize what I think is super basic, but sometimes we forget about it. And that's that if you invest in the stock market index, let's say you buy the TSE 300 index or the Standard & Poor's 500 index, you can actually do that by buying one of these ETFs and just holding on to it for 10, 20, 30 years. So over the long term, you will make money in the stock market. If you bought the stock market today and looked at it and did nothing to it, just held on to it, in 20 or 30 years, it will be higher, almost for sure. And why is that? It's because the TSE 300 index, or let's say for sure the S&P 500 index in the U.S. are 500 companies, the leading companies in the U.S., most of them the leading in the world. And they're going to be growing over the next 10, 20, 30 years. You know, they reinvest their profits to make more money. The population grows, there's inflation, on and on. So, you know, those companies will be growing and growing, their profits will be growing. Now, it's also the Standard & Poor's 500 doesn't stay the same companies. There's only 1/3 of the original 500 that were started in 1956 still in the index. You know, Woolworths is gone, and Northern Telecom is gone from the Canadian index, and so on and so forth. There's companies that fail, and then they bring in, like Tim Hortons was introduced 7 or 8 years ago to the Toronto Stock Exchange. Facebook and Apple, you know, they come in. So you have this changing group of growing companies, which over a long period of time is going to do extremely well. But we humans don't do it a straight line. We have this knack of getting enthusiastic and not in big waves. And so what happens is, and it's been proven that after, if these are all like years down here, this is over, let's say, 40 years, things go up for like 4 years, and people get really enthusiastic up here. And they buy more, they take more risks, and so on and so forth. And then all of a sudden markets go down, and they get panicky down here and sell. So that there's been research done, and I get a research report every year which shows how in the long-term basis they are losing about 5% per year, believe it or not. So this long-term upswing is likely 6 or 7% a year, and here we've got people losing 5% of that by simply doing the wrong things. So what we find is in these top periods, you know, stocks are, you got your value is expensive up here. And you've got your sentiment. People are overly optimistic up here. And on the economy, you know, the economy is running hot and they're raising interest rates to cool it off. So that's bad. So down here, you've got the opposite. You've got stocks that are cheap. You got sentiment, which is panicky. And you've got the economy going from a recession into a new era. So all I'm trying to do with that background indicators is, first of all, stop doing the wrong thing, which is getting enthusiastic up here and panicky down here. I want to do the opposite. I want to take advantage of these swings. Now, if it wasn't for that, I would say the best thing to do is nothing, like just buying an index and holding it without worrying about it. That is a better thing than just scrambling around in the stock market and making all these common errors. So that is, I think, an important thing, and this is what we'll be trying to do over the next year or so if the stock market gets too high. So we're here on a growth objective, and we're going from a minimum, maximum sort of range. Right now we're at the maximum, but I had said over the last year, if we go up 10 or 20%, we're going to start going down in our holdings of stocks. So the other thing is, at the moment, what type of stocks are we doing? We're looking at Trump-orientated winners. We don't have to worry about bonds because we're not doing them. So let's look at the stocks we're doing. So now, what we're looking at the Trump favorites, and what are those? Well, first of all, for all businesses, things are looking up in the U.S. They are looking to drop business taxes from about 35% down to 10%. So that's a general reduction in taxes. So that is hugely positive for the stock market. That also means that overseas money that is locked overseas can be brought back to the United States. So for instance, let's say Apple Computer makes profits overseas. They've been leaving them there because if they brought them back to the US, they would be taxed at 35%. So they just leave the money over there. Nowadays, the total amount of US profits that are sitting overseas in cash is about $1 trillion. So when they make these tax changes, that money can be repatriated and it can be used for all sorts of wonderful things, such as buying back people that own shares of their companies. It could be used for higher dividends, and it could be used for building factories or expanding and so on and so forth. So that is, generally speaking, a great thing for the whole stock market. But the most favorite industry is the banking industry. You know, under Obama and also Hillary, you know, we are going to see more and more regulations. Okay, now we're going to see deregulation of all the things that Obama put on. Higher interest rates that I talked about with Trump coming in benefit the banks more than anybody because they earn higher interest rates when the bond market yields go up. And the industry oversight is dramatically different. We have a bunch of ex-Goldman Sachs presidents and senior executives now in key posts in the U.S., particularly in government oversight and stock market oversight. So you can imagine that that is going to be basically taking the handcuffs off Goldman Sachs and the crew for the next 4 years minimum. On energy, we have also deregulation, more pipelines approved. The industry oversight now is the former governor of, Rick Perry, the former governor of Texas, is now running the energy department. I mean, forget the green movement. He is the drilling movement. The black and white difference in oversight versus what would have happened under Hillary. Now, don't get me wrong, I don't agree with many of these things, whether it's banking, energy, or whatever. I dislike the man's personality dramatically. But, you know, you want me to be investing based on what the business, what's favorable for business, favorable for investing. So if it turns out that they want to make America great again, and they're doing it via higher stock prices in America and with a higher currency down there, then I'll be investing down there. You know, I'm going to be investing where we can get a decent rate of return with as little risk as possible. Now the other thing is US-based industrial companies are also favored because of this America First type of policies. So those are the key things, and we have spillovers into our banking, our energy business. We're next door to the US. So, you know, there's many things that are happening that are good for the Canadian market as well. Now, when we're looking at investing, I also look at the currency. If you remember last year down here when the market, the exchange rate was extraordinarily good for Canada, that's when I was telling people they should delay buying their currency because I thought the Canadian dollar was going to go up, and sure enough it did. But since the Trump election in November, the trend of our dollar has gone down. Recently, in the last few weeks, it's gone up a bit. But, you know, there's a lot of negatives out there potentially for the Canadian dollar. We have their interest rates are going up, and ours aren't. Our governor of our Bank of Canada clearly has indicated that he wants to see a lower Canadian dollar. We also have them tweaking, they say, the NAFTA agreement. and it's a risk factor on the various trade policies, etc., versus the U.S. Oil prices have helped us. Higher oil prices helped our dollar, but I think we're getting near the end of that as a potential boost. So generally speaking, I'm thinking the Canadian dollar could be weaker rather than stronger going forward. Now let's take a look at the types of stocks we own in relation to what I was just talking about. So here we have the, this is the Canadian Equal Bank Index, ETF. So this is Canadian banks. Now, what I do, this upper chart is the 9-month relative performance between the bank index and the US stock market and the Canadian stock market. So if the Canadian banks are doing better than these markets, then this index up here will be above 0. And sure enough, it is. So over the last 9 months, the Canadian bank index is doing better than both the US and Canadian indexes. And when I look at all of these, everything is in these charts is in Canadian dollars. So the conversion is part of the charts. So the Canadian bank stocks are doing well. Now I've rebased the charts also at this lower area to see what is leading. And the last major starting point for the stock market, I believe, is the Trump election day, November 8th. So this is the Trump election day here. Going forward, what we're seeing is, in black here, is the Canadian bank stocks are outperforming the US and Canadian market. So this is certainly a favored group. So you can see it's up about 14%. Now some of these other, we have individual Canadian bank stocks as well, Canadian Imperial Bank of Commerce, we've got the Royal Bank, and the big standout performer is Bank of Montreal, which is doing about 4% better than the other two banks. So we have individual banks as well. Now this is the US bank ETF, priced in Canadian dollars. So this is the US equivalent to an ETF in their banks. And what we see here is that, as you remember, the previous one in the Canadian banks was around 14%. This is around 22% at this point. It's up even higher at the moment. So it is outperforming both the US and Canadian stock market as well. And up here is quite a bit higher than the 0 reference line. You can also see that before the Trump election, US bank stocks were underwater here and underperforming very dramatically. So when they talk about these bank stocks being up, they came from a very depressed standpoint. So not only do we have the ETF here, but we also have individual bank stocks as well. This is Morgan Stanley. And Morgan Stanley is outperforming the market even more than the bank index. The other area that's outperforming is US broker-dealers. And we're talking about things like Charles Schwab and all the other various US brokers and mutual fund companies, etc. So with a strong stock market, here we have this group doing very well versus the market. And once again, you'll see that it was underperforming the general markets for quite a while. And under the Hillary presidency, there was going to be extreme regulation of the investment industry. Now it isn't. Energy is a little bit of a quandary right now. Let me go on to the other chart on energy here. In the US energy industry is outperforming the market. Here we have it since the Trump election, outperforming. But in the case of Canada, it was outperforming, but now it's underperforming here and in here. So there's some problem potentially with a border tax hurting the price of Canadian oil. And also I think that the feeling in the industry is that the U.S. environment is going to be much more conducive to a strong industry down there. And so I think people are selling Canadian stocks and buying U.S. stocks. So this is an area I've lightened up on recently and will continue to going forward if it continues to starting to underperform. Spartan is an example. It's in the last few weeks has started to underperform a bit. Altura is a junior company that we own. It's doing absolutely super over the last few months. It's up 60 or 70%. So it's really just getting started. It's more or less a brand new company, brand new management, and they're building what I think could be a successful company. Here is the industry. This is industrial ETF in the US. Once again, it's outperforming the market. This is in the industrial ETF, you've got everything from airlines to General Electric to aerospace and defense, trucking, that sort of thing. So it's a broad participation in the U.S. economy. Once again, being favored by Trump. This is the Internet ETF. We have the Internet ETF is outperforming since the Trump election, more or less in line with the markets. But whenever it's outperforming, we should own the Internet ETF, and we do. IBM doing great. Restaurant Brands, which is Tim Hortons and Burger King merged and created Restaurant Brands. This chart is a couple weeks old, but it's really soared up here in the last week or two. They came out with great earnings, and company is doing super. We own some of the Russia fund. That's the only emerging market fund that is doing reasonably well. We own some of that. Canopy, we got back into it. This chart is a week or so old, so it doesn't show the great gain we've had here recently. It was up to 13 there a couple days ago, and now it's back to 12. So we bought it around 10 and a quarter, so it's up 16 or 17% since we bought it. But as I said in my email to people, after this big volatility, I was waiting for it to sort of calm down. That's the black line here. It did, and I thought that the big thing was going to be out here, where we had the legislation going through in Ottawa for the personal use for marijuana, and I thought that I was going to really solidify the industry, get a lot of excitement around it. The stock, I think, would be a lot higher at that point. So I stopped delaying on buying it back, and we bought some at 10 and a quarter, 5% position. If it shoots up too quickly, might sell part of it, but I am looking at holding as much as we can, unless it gets really silly, too high priced, but we'll be holding some when they actually pass the laws. The company changed the name, the symbol that is. It used to be CGC, and now they changed the symbol to WEED, weed. So that's, I think that was a good move. Every time people look at the stock symbol now, they'll know exactly what Canopy is doing. So that could be worth a few percentage points in the stock performance. But they're the leading company in the industry. They have 29% of the industry. It's going to be a huge industry in the future. And I'm not just necessarily just buying this for a stock play for a few months. I think it's going to be a big industry in the future, and we should own it when it's reasonable. On the watch list, this is a fund I think we'll be owning. It's a buyback, what they call buyback ETF. Companies that are buying back their own shares in the open market with their profits go into this ETF. So, I mean, Apple, for instance, is a good example of one of those companies. And so here we can see that it's outperforming the Canadian and U.S. stock market. And I would say that when they start passing that legislation about allowing that money to come back from overseas, there'll be a lot more stock buybacks. And when the companies are buying back their own shares, you tend to see the stocks go up. Big demand for the shares. So this is one that I think we'll be owning quite a bit somewhere down the road. And the kind of companies that are in this ETF are very high quality companies. And we have the, this is another one I'm watching, the transportation average, which is a lot of airlines and trucking and so forth. A couple of Canadian dividends. And I'm also watching for India. I still think that India could be the great growth story. So this is India. It's underperforming somewhat since the election. All the emerging markets crashed after the election, including, more importantly, Mexico, because of all the uncertainty around NAFTA and building the wall and all that stuff. So I'll give you an up close on this, but this is the portfolio. I'll be sending this to everybody. Here we have all the Canadian banks, U.S. banks, and the broker-dealers, etc. And all of this equals 54% of the portfolio for financials, which is a very high weighting. I'll talk about these weightings later. We have the oil and gas at around 11%, 12%. We have the U.S. industrial ETF at 13%. Restaurants International. We have Canopy, IBM, the Internet, and Russia. So let me just give you a close-up of this bottom part, which is where the performance really comes from, which is the industry groups that we're owning. So this is an up close to the previous table. And so over here with the currency exposure, we're 61% in the US, 29% in Canada, and a little bit in the Russian ruble. So in the industry groups, where we're really heavily weighted is in financials. So as I was saying, the best performing area has been financials, and that's where we're at. And it's totally logical that that is going to be a good area. The stocks were cheap going into the election. They have high dividends, high earnings. They're going to be favored as far as boosting earnings under Trump. And so I think it's really rational that we own this high weighting. The U.S. index has only got 14% in the banks. We have in our index 36%. That's not just banks, it's financials. Financials are also include insurance companies and mutual fund companies and broker-dealers, but we basically own mostly banks and a few of the brokers. Energy, we're at 12%, which is much higher than the U.S. market at 7%, but lower than the Canadian. We were as high as 24% recently, but because as they started to underperform, we switched into other things. That industrial ETF is 13%, so we're a little bit high there. Others are pretty well in line. Infratech is IBM and Internet. 7% here is in restaurants, international. Now, where we don't have the areas that are doing worse under the Trump administration are healthcare. We don't have anything there. And in the dividend type areas, because of the shooting up of interest rates, we have these high dividend areas like utilities, real estate investment trusts, telecom. These are the poor areas, and we hold very little in them at all. So that is what's happening. We're looking to somewhere over the next period of time, if the market goes up or interest rates go up, to be scaling out of the market because it'll be increasingly more dangerous the higher it goes. And also, you know, as the things we're owning that are, when we're in the market, are the ones that are being favored most, which are financials, somewhat industrials, somewhat energy, etc. And that is the story.